Numbers can seem intimidating, but in multifamily investing, understanding a few key metrics is crucial. Welcome to our channel, your go-to source on everything about multifamily investing. Today, we're going to break down terms like DSCR, cap rate, and cash-on-cash returns into simple, easy to understand terms. First up, debt service coverage ratio, or DSCR. Think of this as your property's report card, specifically for lenders. It's a simple tell that tells your property's income is enough to cover its mortgage payment. The formula is a straightforward DSCR equals net operating income, or NOI, divided by the total debt service. That's your total mortgage payment, including principal and interest. So let's say your property's NOI is $120,000 per year, and your total mortgage payment for that year is $100,000. When you divide $120,000 by $100,000, you get a debt service coverage ratio of 1.2. Lenders typically look for DSCRs of 1.25 or higher because it tells them your property is generating 25% more income than what's needed to cover the mortgage. If your DSCR is below 1, that means the property isn't generating enough income to even cover the mortgage, which is a major red flag. This is a critical metric for securing financing and understanding your loan risk. Next, we have capitalization rate, or cap rate. This is a very common metric, and it's essentially the expected rate of return on your property if you bought it with all cash before any debt. The formula is cap rate equals net operating income, or NOI, divided by the property's value. For example, property's NOI is $100,000 and the property is valued at $2 million. Your cap rate is 5%. Now, how do we interpret that? The higher cap rate often implies the higher potential return might also indicate a higher risk or less desirable market. Conversely, a lower cap rate typically means a lower return, but it's often found in a more stable, high sought after market. Cap rates are essentially comparing similar properties and for getting quick sense of the property's value within a specific market. Finally, let's talk about the metric every investor loves: cash on cash returns. This is the most direct measure of how much cash you're getting back annually on the actual money that you invested. The formula is simple. Cash on cash return equals your annual pre-tax cash flow divided by the total cash of your investment. This includes your down payment and any closing costs. For example, the annual cash flow of all expenses is $20,000 and your total out-of-pocket investment is $200,000. Your cash on cash return is 10%. That is what truly tells the investor your annual return of the money that you actually put into the deal. Understanding these three metrics, DSCR, cap rate, and cash on cash return, empowers you to confidently evaluate a multifamily deal and make smarter investment decisions. But if you don't have millions and you don't want to manage a huge building yourself, this is good news for you. For more in-depth information and how to explore how you can get started with a large-scale multifamily opportunity, visit us at aiventuresllc.com. We're here to help you get started. Once you're done, then be sure to check out our next video where we're exploring how syndicators like ARK Investment Ventures can open doors for large-scale multifamily deals. Don't forget to like, subscribe, hit the notification bell for updates. Thanks again.